Why it's crypto and not Bitcoin, that's the real scam here. Now, with the cryptocurrency markets melting down in the aftermath of FTX and Alameda declaring bankruptcy, taking down BlockFi and damaging many other major players like Gemini, Genesis, Crypto.com, and more, there's a lot of confusion over the entire cryptocurrency space, with headlines asking all types of questions like, is this all a scam? Or is all of this a giant Ponzi scheme? And should government regulators shut all this down to protect the people? And in the middle of this noise, which I mentioned during my 2 videos breaking down the FTX scam, that you hear people like me saying, Bitcoin, not crypto. And you asked for a video, so here it is. So in this video, I'm going to break down why myself and many others are saying Bitcoin, not crypto. What this means, why there's a massive distinction, how to understand this easily, how to value and measure, and of course, how to protect yourself from falling into the next crypto scam and more. So let's go. All right, welcome back. I know you guys were waiting for this. It was a very highly requested video after the 2 videos I did on FTX. You wanted to know why I said Bitcoin, not crypto, or why do people say that overall? And so I'm going to bring it to you. Now, just real quick before we jump into it, I got a lot to cover. I do want to say 2 things. One, I have another YouTube channel called Market Disruptors. If you'd like to watch my radio show and my podcast over there, a lot more current events, a lot more deep analysis. So check out Market Disruptors. We'll link to it in the description. And I'm hiring. If you'd like to work with me, we're looking for copywriters, we're looking for social media managers, we're looking for a lot of people. There's a link down below. If you'd like to work with me, if you like this type of content and want to get paid for spending time in this, check out that and let me know if you want to work. All right, let's dive into this video here. We're going to run real quick. Now, I do want to say a couple things. We are going to talk about the difference of why we say Bitcoin. I say Bitcoin, not crypto. There's a lot of stuff I'm going to be leaving out of this, specifically that I want to talk about, which is what I think is going to happen with regulations around Bitcoin and cryptocurrency, what I think that means for the future of cryptocurrency and Bitcoin moving forward, why I think we might not see another crypto bull run. There's a whole lot of that I'm going to leave out. I'm going to put in video number 2, which will drop in a couple days, or if it's already out, I'll link to it down below so you can watch the second video. All right, let's go ahead and jump into this. So again, Bitcoin, not crypto. What the heck are we talking about? Well, you have to understand the reason why we make that distinction is because they're different. Now, we're not saying Bitcoin is not cryptography or not cryptocurrency. They both use cryptography, but that doesn't really matter. What we're saying is there's massive distinction. There's different properties, sort of like gold and other metals. So there's all types of metals, but there's only one gold. You have steel and you have aluminum and you have chromoly, and of course you have platinum and palladium and silver, and they're all different. They're all metal, but they all have different attributes. So for example, gold is one of the best conductive materials. That's why you'll see them on like, audio cables and things like that. So gold has unique properties that make it much different than normal steel or aluminum or things like that. And just like that, there's other attributes. So another example is what we got here, Beyond Meat. You guys know about that, I'm sure. Luckily, they're tanking. The market doesn't like it. But look at the ingredients of Beyond Meat. They have expelled pressed canola oil. If you don't already know, stay away from seed oil. Seed oils are one of the worst things that we can have, and it's in everything. Of course, it's the number 2 ingredient in fake meat. We have maltodextrin, we have sunflower oil, another seed oil, stay away. We have modified food starch, doesn't sound super healthy. Cellulose from bamboo, probably not. Methyl cellulose, I can barely pronounce it. We got annatto extract, whatever, vegetable glycerin, more seed oils, vegetable oils. No, stay away from this. So this is the ingredients of Beyond Meat, and what's in real meat? We got that. So you can see that Beyond Meat and meat are not the same. And so gold and aluminum is not the same, and Bitcoin and cryptocurrencies are not the same. So how are they different? Well, let's go ahead and keep digging in. So first of all, why Bitcoin? Bitcoin is the revolution. We'll talk more about that in a second. Bitcoin is revolutionary. What are some of the attributes of it? Well, it's borderless, right? It doesn't know anything about borders. It's just a computer network that can be used anywhere in the world. It's permissionless. So anybody can just grab a computer and join the network. You don't need permission. It's censorship resistant. Nobody can steal it from me, and more importantly, nobody can censor it. Meaning, if I want to send it to you, nobody can stop it, block it, or prevent it. It's immutable. If you send it to me or I send it to you, once you have it, it's yours. It can't be reversed, and then it's scarce. There will never be more than 21 million Bitcoin. All right, so it has all the attributes. Now you might say, well, so do cryptocurrencies. Cryptocurrencies are borderless too. Okay, granted, I'll check that. Okay, they're permissionless. Really? Okay, well, how do you run a node, a validator node on Cardano? Do you need to get upvoted, and how do you get those votes, right? So is it really permissionless? You might say it's censorship resistant. I'll cross that out. You might say it's censorship resistant, but as we'll explain in the next section, maybe not. Actually, let's just go ahead and jump into the next section so you can understand these a little bit better. All right, the real revolution here, the technological revolution, is decentralization. All right, now you have to understand this. It's not having faster money. That's not the revolution here. Faster money isn't needed. Credit cards are already fast. All right, the revolution is decentralization. There's been 5 technological revolutions in the last 300 years. Industrial revolution, steam engines and railways, steel and electricity, oil and automobiles, microprocessors, which brought us telecommunications, brought us the internet, and brought us to where we're at. Now we're witnessing the 6th, and it is decentralization. What makes it that? Well, as the word sounds, it's decentralized. So we have centralized databases, meaning Wells Fargo or JP Morgan run a database, and they keep track of all their customers' accounts, right? You have Facebook that has a centralized database. Experian, the credit reporting agency, has its own database, and they were hacked. It was the largest data breach in U.S. history, and everybody's sensitive data, mother's maiden name, social security, date of birth, all was leaked onto the internet. That's having one database. Now, decentralization would be the opposite. Instead of having one database, you have many, thousands, hundreds of thousands, millions of databases. Now, instead of having $1 million in one bank that someone might want to rob, you have $1 in 1 million banks. And who would bother? And so that's why Bitcoin is the strongest security network that we've ever seen in history. There's been over $1 trillion sitting there in an open source network, and it's never been hacked. Now, in order to have a decentralized database, that means we need to have many. The more that we have, the better. And in order to do that, in order to do it in a way that's permissionless, is everybody needs to be able to run one. And so, with Bitcoin, you can. You could be anywhere in the world and have a 5-year-old laptop, and you could download the Bitcoin database, and you could run it. All right? The entire Bitcoin database is under 500 gigabytes. It's about 450 gigabytes. You can buy a 1 terabyte thumb drive for your computer for about 20 bucks. Anybody can download the database and run it. You can be in Africa, you could be in Chile, you have an old laptop, and you can run it. But you can't do it with Ethereum, you can't do it with Cardano, you can't do it with fill in the blank. All right, like I said, everyone needs to be able to run it in order for it to be decentralized, because my ability to run a database means I can verify the database at all times. If I was going to pay you with gold in the old days, how would you know how much gold is in this metal, how much it weighs, is it real gold or not? So coins was an invention, and coins now were stamped, so I'd know, okay, this coin is probably this denomination. I still don't know if it was clipped. I still don't know if it's counterfeited. And so today, if you wanted to pay me in gold, I would need some specialty equipment to know, to find out how valid or how pure that gold is. But with Bitcoin, I can run my own database or my own node. And so when you send me Bitcoin, I know if that is a real Bitcoin, if it's a valid transaction, and I can automatically always know exactly how many Bitcoin are on the network, how many are in existence, and where they're at. Without being able to run my own database, you can't do that. There's no way to know exactly how many Ethereum are out there today, or XYZ. There's over 20,000 cryptocurrencies, and we'll talk about that in a minute. Every one of them compares to Bitcoin. It's very hard for me to know about every 20,000, but that's basically the case. All right, let's keep going. As I said, this is a real revolution, meaning it was an invention. It's something we haven't had before. And when it was created, Bitcoin was created by an anonymous creator, Satoshi Nakamoto. He worked with a group of developers that we know, Hal Finney, Nick Szabo, Adam Back, But when Satoshi Nakamoto released the code, he invented it, and he released the white paper, and he released the code. And this is a key piece, no issuer. When he created the database, released the code, he didn't mine any for himself. As a matter of fact, he released the code and allowed everyone to get access to it first before he started mining it. He mined a first block that he just put a message into. There were no Bitcoin there. So Bitcoin is a digital commodity, all right? Well, I'm going to break this down in video 2, but it had no issuer, all right? Unlike other cryptocurrencies where the founders create a bunch of tokens for themselves. Now, I'm going to be picking on the number 2 cryptocurrency, which is Ethereum. And again, fill in the blank for any other ones that you want. But the number 2 cryptocurrency, Ethereum total supply, this is directly off of the Etherscan website, so this isn't some propaganda, it's directly from them. We can see right here the Ether distribution overview. The Genesis block was 60 million tokens in a crowd sale, plus 12 million other, or 72 million Ether. Okay, so about 70% of the Ethereum tokens were done in a pre-mine. A pre-mine means when Vitalik Buterin and friends got together and created it, they created 70% of the tokens and kept them for themselves and gave them to their friends. Unlike Bitcoin, who had no issuer. They created the code and issued the code, but no tokens. It was a fair distribution. Now, it's not just Ethereum that I want to pick on. Pretty much every coin was like that. So we can see here, Ethereum, 12 million coins. Ripple, 100% of the Ripple tokens were created and sold to enrich the founders of Ripple XRP. Stellar Lumens, 90 billion were done in the pre-mine. Cardano, 20% of the tokens were done in a pre-mine, about 26 billion tokens of Cardano. Dash had 2 million on a pre-mine. Tron, 100 billion. Neo, 100% pre-mine. So you can see pretty much every other token, the originators created not just the database, not just the code, but created the tokens that they got to keep for themselves. Unlike Ethereum. Now the other thing is, like I said, he wrote the code, released the code, but didn't issue coins. Anybody who wanted it had to go buy a computer, plug it in, purchase electricity, purchase energy, and run the database in order to get Bitcoin. The exact same thing that you can do right now today without permission. This is a huge deal. This is what makes it a commodity, and this is what makes it different than the other 19,999 or however many cryptocurrencies are at this point. We'll be talking about that more in video number 2. All right, now, by doing that, this is a key piece here. You have to understand these intricacies. Each one of these could have its own video, all right? If you want me to do a separate video on each one of these, you can just leave me a comment down below and let me know which ones you want. Also, while you're leaving that comment, you could also hit that subscribe button if you're liking the content I'm putting out. So this removed seigniorage. Why? Why do we even need this, Mark? Well, it removes seigniorage. What does that mean? Well, seigniorage is the amount of money an issuer makes of issuing the currency. So the United States government, or I should say the Federal Reserve, when they create $1 trillion, how much does it cost them? 0. All they do is push a button. Now in the old days, they actually had to make coins or print dollars, and so they actually had a cost to print those dollars, and the U.S. Treasury still has to pay that amount, I suppose. But they would have a spread, how much they would make. The seigniorage, how much money they'd make for creating the currency. On top of it, that seigniorage, it also is something called the Cantillon effect. And what that means is whoever's closest to the money supply benefits first. They get the money first at the cheapest, and then when they spend that money, it creates inflation. The person who gets the money next gets it the second cheapest, but prices have already gone up a little bit, prices go up even more, and by the time it gets to the last person, they get the money for the most expensive and the most inflation. So, an example of that, think about BlackRock. Going and buying up all the single-family homes in the United States. They're paying 35% more than market value, more than what you would pay, more than you can afford to pay. How are they able to do that? Well, because they get the money for so much cheaper. So they get the money for so much cheaper, they push the price of the homes up. Then when you go get the money, it costs you more money to borrow, and the home prices have gone up. That's the Cantillon effect, all right? So Bitcoin removes that. Remember, anybody can go get a computer and go mine Bitcoin today. It's completely fair. Everyone has the same opportunity to do that. No one can create it for themselves, like Ethereum and Cardano and XYZ. All right, so crypto, we say Bitcoin not crypto, because crypto reintroduces that. Ethereum, pre-mined it. Cardano, pre-mined it. It reintroduces the Cantillon effect. It also reintroduces trust. And so remember, Bitcoin is trustless. Because I can run my own database, I don't have to trust anybody. When I get the Bitcoin, my node can verify it, and I always know how many are on the network. How many Ethereum are there on the network right now today? You don't know, and nobody else does either. It requires trust. And so all the other 20,000 cryptocurrencies have some form of trust. In the decentralization aspect, because on Bitcoin everyone can run a node, we know that it's decentralized. But how do you run a node on Ethereum? Or run a node on Cardano? Well, you need a professional grade server, and it needs to be co-located in a professional grade co-location facility, which means about 70% of all the nodes are in hosted facilities, which means that with a flip of a switch, like that app Parler, when Trump tried to go to Parler, they shut it down. First the App Store shut it down, then Amazon shut it down. And if all of the nodes are in hosted solutions, they can also shut that down. But Bitcoin nodes aren't in hosted solutions. Bitcoin nodes are running at like people's offices, I won't name, and people's houses. You can literally buy one and just put it onto your Wi-Fi and you can be running your own node, and they do. And so I don't have to trust anyone to not shut my node down. I don't have to trust anyone not to seize my coins, and that's the big difference. Also, crypto reintroduces centralized financial services and custodians. We have to trust those as well. And so you trust FTX not to steal your coins, and of course, you lose that trust. All right, the other thing. Now, what backs it? So people would say, well, what backs this? What backs Bitcoin? What backs cryptocurrency? Well, first of all, nothing, because all value is subjective. I talk about this a lot. I can go into a whole video just on this alone, but an example would be last night, I threw my leftover food away and dumped out the water in my cup. If I was on a deserted island, dying of hunger and thirst, I would give every penny I had for those leftovers or that little bit of water in my cup. It wasn't worth anything to me last night, but dying on a deserted island it would be. So value is subjective. All right. The other thing about something being backed is only debt is backed. So where that whole terminology came from is the dollars used to be backed by gold, because gold was money. And when I put my gold in the bank, they issued me a paper gold certificate or an IOU or claim. And it allowed me to take that claim and go claim that gold whenever I wanted. If I gave you the paper gold certificate, you could go claim the gold. So that debt was backed by the gold. Today, money, or what we consider currency, is not backed by gold any longer. Remember, only debt is backed. So gold, oil, wheat, those are commodities. They're not backed by anything. Gold's not backed by anything. Oil's not backed by anything. Wheat's not backed by anything. Fiat is not backed by anything. Bitcoin is not backed by anything. And crypto is not backed anything. But that doesn't mean it's not valuable. So how do we look at the value if it's not debt and it's not backed by anything? Well, there's many ways we can do it, and I'm going to show you a couple of them. One is something called network effects. All right, so what that means is that the bigger the network grows, the more valuable it becomes. If I'm the only person in the world with a phone, the phone's not worth anything. Who am I going to call? As soon as one other person gets it, it's a little bit valuable. 10 people, more valuable. And when everybody in the world has one, it's extremely valuable. Network effects. The larger the network, the more value is there. All right. The other thing with network effects is once they get big enough, they're almost impossible to break. So, for example, a lot of people still use Facebook. I could go hire some developers overseas and I could create a copy of Facebook, and let's call it Mark's book. It doesn't mean the network is going to come over and use Mark's book. All right, I could go make a copy of Instagram or Twitter or fill in the blank, but it doesn't mean anybody's going to come over and use it. Once the network effects are there, it's impossible to break. As a matter of fact, we can even quantify them. Here's a study that was done right here. At NFX, we work with over 300 companies to maximize their impact. There's a single property we've seen that lies behind most of the success. That property is network effects. All right, that's the single greatest property to look at the success of companies. As a matter of fact, it says that we started with a back-of-the-napkin calculation. We focused on 336 of the top companies, valued over $1 billion in technology. So 336 companies, over $1 billion in tech. It's a big sample size. searching for signs of the 13 different network effects responsible for 70% of the total value. It says over 1,400 unicorn companies in technology, the network effects are responsible for 70% of the value. So the network effects are responsible for the value, not the servers, not the development team, not the technology for the tech bros out there. No, the network effects were responsible. So we want to look at network effects. Now what we can see here, here's a picture of the Bitcoin database, and we can see right here the number of users on the network, and look how fast this is growing. Remember, when there's one user here, it's not worth a whole lot. When there's 25 million users here, it's worth a lot more. We have the users, but we also have the network itself, which is the amount of computers that are securing the network and processing transactions, and we can see the growth of that network as well. And remember, the more computers, the bigger the network is, the more secure, the more robust that is. The other thing is that, money needs to have a lot of attributes: durable, portable, divisible, fungible, but it also needs to be saleable. All right, and so we can see how much use it's having. We know that Bitcoin is one of the top currencies in the world already. You can go pretty much anywhere in the world and find someone to take a US dollar. You can go anywhere in the world and find someone to take gold. You can go anywhere in the world. I don't know if you could find someone to take a Mexican peso, but you could go almost anywhere in the world and find someone to take Bitcoin. Now, if we take a look at this, here's from CoinMarketCap. This is a snapshot from today. And we can see that the daily volume in Bitcoin is about $35 billion, $35 billion. And then we can see Ethereum number 2 is at 13. So well under 50% of that. Now we have stable coins right here. And if we jump all the way down to here, here's Cardano, not 35 billion, it's at 364 million. So much, much smaller, and of course it just kind of gets smaller from there. So you can see what the network effects are doing in real time. All right, so now that we've covered the network effects and how hard they are to break, now let's look at some real tangibles, some realities. Actually, we'll call it real. Real versus abstract power. Now this is, I hate to say maybe the most important, but it probably is the most important thing. This is reality, all right? Now you can have your fairy tale world and you can dream at night and you can fly in your dreams and you could have a unicorn in your backyard and all those things, but that's your dreams. Then we have reality. And I understand today's day and age, that line of reality is very blurred because we have, the president coming on and telling you all kinds of things like, we'll have renewable power for everything in 5 years. Like, it's a nice dream, and I also like a unicorn too, but we have reality. So let's talk about reality versus abstract, real versus abstract power. And this is really where Bitcoin separates itself from what we'd call cryptocurrency. Before we dive into the differences, let's hear, the second largest cryptocurrency is Ethereum. Let's hear directly from the founder of Ethereum, Vitalik Buterin, on what he has to say right there. Let's go ahead and play that video.
One of the ways that I think about this in a more philosophical way is like, proof of work is based on the laws of physics, and so you sort of have to work with the world as it is, right? You have to work with, electricity as it is, hardware as it is, what computers are as it is. Whereas because proof of stake is virtualized in this way, it's basically letting us create a simulated universe that has its own laws of physics, and that just gives us as protocol developers a lot more freedom to optimize the system around actually having all of the different security properties that we want, right? And
all right, so he says that we didn't like the laws of physics. Okay, the laws of physics can't be broken. That's reality. So he likes this virtual world where he could have his own laws of physics, and that's fine. In a video game, you can fly in the video game, right? And you can be bulletproof in a video game, and you can do all those things in the video game, which he likes, and that's like a virtual reality world, and that's good. But at the end of the day, real world physics apply. So you can create whatever security protocol you want in your virtual reality world, but if me in the physical world comes over and unplugs the computer, you're out, right? Your life is over. So while it's cool that he can have this virtual world where he can have whatever he wants, it doesn't take away the physical laws. So let's take a look at this. This right here is physical power. All right, this is the U.S. Navy, the most powerful Navy in the world, able to exert power from anywhere. Here we have Jason Lowry. He's on Twitter. You can find him here, Jason P. Lowry. And I'm bringing his profile up so I can show you what he's doing. U.S. Space Force. He's at MIT, and he's a U.S. National Defense Fellow. Okay? So he's not just some nobody. No, he's working in Space Force, a defense fellow at MIT. All right? His whole job is to study this. This is what he does, and I'd highly recommend giving him a follow. Let's take a look at a couple of the things that he said. Not Vitalik Buterin living in a false, fake world with no laws of physics. He says right here, just to say this was what was the date on this? Just the other day. He says, I've been invited to advise the White House Executive Office of the President. Okay? He's not some guy that wants to ignore laws of physics. He's living in the real world, and he's going to advise the president on the national strategic security benefits of Bitcoin. Not crypto, of Bitcoin. All right, now let's take a look at what he has to say. All right, now he drew this out, and he draws what he calls the physical power. Now, physical power is measured in watts, kilowatt hours, megawatts, gigawatts, that's power. Nuclear reactors, they're measured in power. The U.S. Navy is measured in power, in actual watts, that's physical power. Now, you have physical power, and you can project this physical power with weapons, obviously guns, missiles, bombs, etc. And that gives you a state of ownership and chain of custody. So, for example, I own this asset. Now, you may want to come take this asset from me. In order to do that, it's going to require an exertion of power, and hopefully, for your sake, you would hope that your power would overtake my power. But if I know how to fight, if I have a weapon, you may not be able to. So this power allows me to exert my state of ownership and my chain of custody. It allows me to retain custody and exert my ownership over it so you don't take it away. All right, that's physical power. But abstract power is artificial. Abstract power is like politics, and they say they have power because they've granted themselves power, but without the ability to back that up with real physical force, they can't maintain it. Now, of course, our politics has a real military with real physical force, but without that, they wouldn't be able to. Here's a better way to look at this. Again, this is from Jason Lowry. I love this example right here. So here we have what he says, real power, so physical power, or measured in watts. So he's measuring it in power or energy or electricity. And then we have imaginary power, which he calls abstract power or rank, politics. So the differences here, characteristics of Captain Eastman's power, who's doing a pre-flight inspection of her A-10 Thunderbolt, a fighter jet, versus Chief Justice Anthony Dudley presiding over the Supreme Court. Okay? So the characteristics of the captain of the warship versus the characteristics of the Chief Justice, who's just in a court. All right? So the person flying the jet with bombs and missiles and machine guns on there, self-evident and self-legitimizing people can instinctively recognize and respect her power. You see the guns, you see the missiles, you see the bombs, you know that she can exert power, versus over here, the Chief Justice over here, he has neither self-evident nor self-legitimizing power. People can't instinctively recognize or respect his power. He looks like a little wimp to me. I don't see that he has any power, right? Over here, unsympathetic. She doesn't need people to believe in or sympathize with her power for it to function. She hits that button, that bomb's going to go off. Doesn't matter if people sympathize with it or not. Over here, he needs people to believe in or sympathize with his power, or else it won't function. Inclusive and egalitarian, everyone can access the same type of power she's using and countervail. So if I get a gun, I can fight back, a bomb, a missile, whatever, I could fight back. Everyone that has access to the same power can countervail each other. Over here, though, not everyone can have access to the same type of power he has because it's arbitrary. He was just voted there. And then finally, energy intensive, requires a great deal of physical effort for her to exert her power, of course, to drop those weapons. Over here, requires minimal effort to exercise his power, just by decree. All right, now you have to understand those different types of power to understand the difference of Bitcoin versus crypto. Bitcoin uses the laws of physics. The power, the amount of energy being used to secure the network is about double of what the U.S. Navy uses. And then that power powers computers that process and secure the network. Computer power is measured in hash power. And if you add up all the computer networks, you take the cloud hosting of Microsoft Azure, and you take Amazon's AWS web hosting, and you add that up, the computer power behind the Bitcoin network is almost 10 times that. That's real, physical, measurable power. Not abstract and not behind the laws of physics like Ethereum and Vitalik Buterin have. Okay, what else? This is another big one. Rules, not governance. All right, now this goes back into the trust situation. Rules, not governance. Rules are fair. Okay, here's a set of rules, and they apply to everybody equally. If I'm playing a game of basketball, there's rules. Now, whether I'm playing someone bigger, stronger, faster, like I'm playing LeBron James, we both have to follow the same rules. Rules are fair. Governance, on the other hand, is not fair. Governance changes based off the whims of that governance. All right, so let's take a look at this. So Bitcoin has a set of rules. The rules are fixed, and everybody must abide by the rules that were set. But crypto, Ethereum, Cardano, fill in the blank, has governance. All right, now what they have is something called decentralized governance. So let's take a look at this. What is blockchain governance, and how does it keep crypto decentralized? That's a good question that they can't actually answer. So it says here, decentralized apps require blockchain governance. It's a buzzword. Sounds really cool, but it's all fake. It's all a scam. Let's take a look at this. I don't like to use the word scam lightly. It's like throwing around the word racist or things like that. I think they lose their relevance. To me, a scam is when somebody sells you one thing but gives you something else. So when they tell you that they're going to sell you something decentralized, but it's not, in my opinion, that's a scam. That's the definition of it. Okay, so that's what I'm talking about here. So they're telling you that this crypto is decentralized because it has decentralized governance. But it's wrong. So if we take a look here, it says spread out decision power to more than a central authority. So that sounds good. That's decentralization, right? Instead of one authority figure, let's spread it out to many. Okay, that's decentralized. It says how and why these projects create a decentralized authority have recently been defined as blockchain governance. They call it decentralized governance. They call it different things. Well, let's dig in a little bit and see exactly how that works. So what is governance? Well, in plain terms, governance is the management, of course, right? So who makes the rules, who governs it, who manages it, right? We know that. For blockchain systems, it says, governance is mostly how the blockchain ecosystem decides on which improvements to enact. So do we want to only mine censored block, like Ethereum's doing with OFAC compliant blocks? Do we want to change the monetary issuance? Do we want to try and change the supply? Do we want to change anything? Well, we do that basically by the governance, right? The ecosystem deciding on which improvements to enact. Okay? Whoever receives the most votes from the rest of the community. So the community gets to vote on it. It's decentralized. The community has a voice. Once the votes are in, the developers then see if the improvement plan succeeds or not. Are you with me so far? So they take it out to the community, they get a bunch of votes, and whatever the community wants, it's like a democracy. Except for who gets to vote? Well, the people with the tokens. Well, who's got the most tokens, which gives them the most votes? Oh, the founders who did the pre-mine and took all the tokens for themselves. And then if I want to take over the network, I just got to buy the most tokens, and then I have the most votes, and then I get to centrally control the network. You see, it's always going to be a weak point. Now we can see here, I pulled this from Freeman Law. This isn't some nut job website. This is from a legal website here. Decentralized governance. An outsider may not be able to differentiate a traditional hierarchy from some blockchain governance rules. So you have to be a crypto nerd to understand this scam that's being played. From the outside, you won't figure it out. It says, for example, the idea of voting for delegates to vote on a participant's behalf is not much different from shareholders electing a board of directors in various publicly traded companies. So like a publicly traded company has shares, and there's a board of directors, and those board of directors get voted up to sit on the board of directors and get to make the decisions for the shareholders. Sort of like when there's a bunch of tokens, and then you elect delegates to go up and make decisions for the blockchain. It's the same thing. There's no revolution here. It's the exact same system that we have today, but we put a blockchain on it. All right. Now, we can see, I have one other one here because people are going to say, but Mark, what about DAOs? DAOs are going to change the world. DAOs are revolutionary, Mark. You're missing it. This is a revolution, all this technology, the DAOs. DAOs are community-oriented organizations. Memberships of the community get determined by the tokens bought and who owns what. So whoever owns the most tokens, sort of like whoever owns the most shares of stock, gets to have the most say. We can think of any DAO, which stands for Decentralized Autonomous Organization. We can think of any DAO, smart contract, as a set of bylaws. So like a corporation has bylaws, it has rules, right? This community-oriented ownership structure, so whoever has the most shares, they're the community, they get to vote on it. And it says that tokens bought by people have functions that are like shares of stock. It says governance, tokens work in the same ways preferred stocks work. So instead of having one privately owned company with a private owner, a CEO making a decision, it's publicly traded, and whoever's got the most shares of stock or whoever gets voted to the board gets to make the decisions, sort of like with blockchain governance or DAOs. Whoever has the most tokens gets the most votes or gets upvoted to a delegate, and they get to change the network. Now, the reason why, if we go back to the revolution being decentralized, is any type of voting or governance is always going to lead to centralization. And then that requires me to trust the other delegates or the other holders not to enforce rules that I don't like democracy, which is a scam. I'm sorry to break it to you. Democracy is a scam. If 10 of us get together and 7 of us say that 3 of you should give us all your money, that's democracy. Mob rule. It's a tyranny of the minority by the majority, which is the exact same thing that we have here. Now, there is something different. So how does Bitcoin different? Well, like I said, with Bitcoin, we have rules, not governance. All right? Now, you might say, but Mark, Bitcoin can change too, just like Ethereum. So Ethereum, if you don't know, has changed its consensus and its monetary issuance, I believe, 3 times in the last 2 years. What if I didn't like those changes? What if I didn't want the consensus changed? Well, there's something called soft forks and there's something called hard forks. Remember, Bitcoin is a set of rules. There's no governance. And you might say, but Mark, there's developers and Bitcoin also makes changes to the network, which you'd be right. But it's how it's done. So Bitcoin uses something called soft forks. Ethereum just went through something called a hard fork. What's the difference? The difference is that soft forks are optional. Soft forks are always backwards compatible. Hard forks are not. So for example, with Bitcoin, in 2017, a book, if you're interested, I'd highly recommend it. It's called The Block Size Wars. They wanted to change the network. They wanted to change the throughput and make the block sizes bigger. That failed. That caused a fork, a hard fork, which we'll talk about in a second. But then there was SegWit, which was installed, which is a soft fork. So me as a Bitcoin user with my own database and my own node, I can choose whether I want to use that update or not. And if I don't, I just keep using Bitcoin the way I like it. If I want to use the new stuff, I can, but I don't have to. With Ethereum, with a hard fork, I am forced to make the change or I'm kicked out of the network. All right, so it's a big difference. That's why it's more like a dictator as opposed to a set of rules that I can follow. Now, Bitcoin did have a hard fork, and so back to the block size wars in 2017, they wanted to make the blocks bigger to get it faster. We wanted to keep it smaller. And so then a hard fork happens where basically they make a copy of the Bitcoin database, but remember the network effects? They made a copy of the Bitcoin database and called it Bitcoin Cash. And they had bigger blocks and faster settlement times, right? That's what everybody wanted. And now the market, the network, remember the network effects, gets to choose which one do they like. But because it was a hard fork, because it was copied, I'm not required to go use that, and I didn't. I didn't want to use that. I stayed on the original Bitcoin. Now the market chose, or I should say the network effects chose, and we can see since that happened, this is when Bitcoin Cash forked from Bitcoin, we can see that since that time, it's down 98.5% in US dollar terms when you compare Bitcoin to Bitcoin Cash. So the market chose, but again, I wasn't forced. I could continue to use one or I could use the other. It was up to me which one I wanted. All right, now Bitcoin isn't volatile. I pause on that. What do you mean? It's like down at like 16,000 right now. Wasn't it like 69,000 at one point? That seems volatile. Well, you're talking about the US dollar price? All right, let's talk about that. So Bitcoin needs to have a price because the price is what gives it security. Because if I'm going to buy a computer, CapEx investment, I'm going to host it at a facility, I'm going to pay for electricity, I'm going to receive a portion of the transactions and some new Bitcoin rewards, that price is what allows me to pay for that, right? I'm going to invest this money and I get something back in return. So the price is somewhat important, but it's also not important because Bitcoin, the US dollar price of Bitcoin, or I should say what people price Bitcoin in, is volatile. But the network itself isn't. So the Bitcoin price is actually somewhat unimportant because I would ask, did the Bitcoin network stop? No. Can I still send money or Bitcoin permissionless? Yes. Did the Bitcoin supply change? No. Can I still verify all of the above? Yes. The network still works perfectly. It still produces a block every 10 minutes. It's still immutable. It's still censorship resistant. I can still verify all the transactions. That's like saying Facebook the price of Facebook, or now it's Meta, stock is down whatever, 75% as well. But does Facebook, the app, still work perfectly fine? And of course the answer is yes, it does. You see what I'm saying? There's a difference there. So the other thing I'd say is that it's the people that are volatile, but what we can see is that the people are starting to use it more and more, of course, in places where they really need it. Think North Korea, think Turkey, think Ecuador, Peru, think Africa. So what we can see is where Bitcoin adoption is taking place is Africa. As a matter of fact, about 80% of all Bitcoin transactions under $1,000 are happening in Africa. They're actually using it in places that they need it. We can also see, I love this chart right here. This is Bitcoin wallets with at least one whole Bitcoin, a whole corner as we call them. And what we can see, the orange line here is the amount of Bitcoin addresses that hold at least one Bitcoin. And then the black line here is the price, the US dollar price of Bitcoin. What I like is this section right here. And what you can see is that the price has come down, but the number of Bitcoin addresses holding at least one Bitcoin have skyrocketed. So remember, the network itself might be volatile. I'm sorry, the US dollar valuation might be volatile, but the network is not. All right, now a DDoS attack. Let's talk about crypto for a little bit. Hopefully you've understood the differences, the decentralization, the censorship resistant. The decentralization is really the key piece here, and I think also the rules, not governance, is the key piece as well. Cryptocurrency is sort of like a DDoS attack. Shout out to Lynn Alden. She kind of gave that to me. We were talking about it at a conference last week. And a DDoS attack, if you don't know, is sort of like a spam attack where basically spam will attack a network and try to shut it down, a denial of service. So it'll overload the server so that it can't serve you, a denial of service attack. And that's sort of like what crypto is. There was, in 2017, there was like 1,000 cryptocurrencies. Today there's over 20,000 cryptocurrencies. And you, the poor unsuspecting retail client, are stuck trying to figure out what these 20,000 things are. And I get it, Mark, it's the tech. Bitcoin's old, it's slow, it's slow. Okay, we can make a whole video on that as well. If you want that, let me know. I'll tell you why Bitcoin is not old or slow. But you have this DDoS attack. Bitcoin has to go through each one of these, and you have to find out the hard way, unfortunately, that each one is just trying to take your money. They're basically like, in the old days, what would be called a snake oil salesman. Hey, look, it's not Bitcoin. This is the next Bitcoin. This is the new thing. It's got this new feature. It's got this new thing. Yeah, it's not decentralized. It's not censorship resistant. It's not immutable. It's not a fixed supply. And yes, I enriched myself, but it's the next Bitcoin. Snake oil. It's all just a distraction. Now remember, the revolution here is decentralization. It's ending seigniorage. It's permissionless, borderless, censorship resistant. Everything else is a distraction, and unfortunately, the innocent are losing billions. As a matter of fact, almost $10 billion were lost in the FTX blowup by poor unsuspecting people that didn't understand the difference between crypto or Bitcoin. But hopefully you do now. Now this might bring up more questions than it answered, and of course light up my comments down below. Feel free to tell me, Mark, you don't understand, but explain to me what it is. I don't want to see a bunch of comments. I already know I'm going to get them. Hey, you're an idiot. You know what you're talking about. Tell me what? Tell me what I don't understand. Show me the proof. I brought you the receipts. Let me see yours. Leave me in the comments down below. Of course, as always, give me a thumbs up on this video if you like it. If you don't, give me a thumbs down. That's okay. But like I said, at least tell me why. I'm looking for people to help me out on my content. If you want a job, check out the link down below. I also have a bunch of resources on this stuff because I know this is going to bring up even more questions. So I got some good resources linked down below, some more videos. Hit that subscribe button before you leave, and that's what I got. All right, to your success. I'm out.